Thank you very much. Just, I will talk to you about some ratings, our country ratings. I just want to stress the fact that we in Coface do not rate the sovereign. We really rate the corporate risk, the average risk in a given country. And we look at how possible how well the corporates will do in terms of payments behavior. So not the government, it's important. And we have 7 grades, A1, A2, A3, A4 for the low risks, and B, C, D for the high risk. And you have to wait for the end of my presentation to know the Hong Kong rating. So it's big suspense. So just one little chart of our history. And you have in the line, the dark line is our non-payment records, or non-payments, the claims we receive all over the world from companies. And the red or purple is the growth, the world growth. And you see that we have a credit crisis almost every 5 to 6 years. I mean, what I call credit crisis, I mean a huge rise of bankruptcies and of non-payments from corporates. So that's why we exist, credit insurers. So we are somewhat useful. And you see that the latest crisis, the 2009 one, was the worst one ever recorded in our history. You see that we've had, of course, a global recession, which is known, but you've seen also that in terms of corporate non-payment, we've never recorded that level before. And for the first time of its history, Coface recorded losses. And that's not clearly, so clearly the risks and the crisis have been absolutely dramatic, but you see also that the decrease has been very fast. It has begun in mid-2009 when the recession has stopped, and then you see that now we are at a very low level of non-payment, clearly. We are in terms of corporate risk at a very, very low, in terms of what we record in our charts, in our books, is extremely low. So clearly the recovery is here, and we have seen an improvement. Now, when you look at our outlook, you see the little orange bar. You see that we still predict decent growth for the world economy, but we do predict a deceleration, and we've talked about it clearly for several sets of factors. One of the factors being what's happening in emerging markets, with clearly overrating issues and treating overrating issues, and also the eurozone crisis and so on, the rising of oil prices. So there are many negative factors which is linked to deceleration, but still we believe that there's going to be quite strong growth. Now, if we look at our ratings in terms of our countries, it's not as rosy as the precedent chart has told us. And you see that, of course, we have a lot of A1 countries, meaning the best risk, than the risk that we have known before the crisis. So Australia, Canada, New Zealand, Sweden, okay, they are very, very good risk in terms of our corporate payment. But let's say they are not the leader of the world economy. So that's not helping us a lot in terms of our global portfolio, I would say, but also in terms of global risks. And you see there was one big player, which was Japan, which we have recorded an excellent payment experience just after the crisis. It's an A1 country. But then, of course, with the shock that's occurring now, of course, the outlook is a little negative, so we put a negative watch. Also, despite that we've revised the Japanese growth to 0.3%, so clearly 3 quarters of recession and one quarter of positive growth the last quarter, it's clearly a blow on the economy. But we believe in terms of corporate payments, the Japanese corporates pay very well. So we don't believe that's going to be a huge impact so far. If you look at the big players, things are getting better. If you look at the US, if you look at Germany, we are in A2 positive, but we are not where we were before the crisis. We are not in A1. And that's very important for us, that we still have some bankruptcy, some corporate difficulties in those economies. Of course, things are getting better, but we are not exactly comfortable at the level of comfort we were before the crisis. And of course, there are those countries where we are not exactly, don't know where they're heading, which would be Italy or UK, which the risks are 50-50. I mean, we have the very bad last quarter for UK, decent but not very great first quarter, and the situation is still very, very uncertain in the UK, and Italy very disappointing growth for the first quarter. And generally we have large non-payments experience in Italy, and the countries that are in crisis, which is of course we're not allowed to call them the pigs. I mean, someone has called them the pigs, so we call them the peripheral European countries. Which is Portugal, of course, Spain, Greece, and Ireland, but I will come back to those risks. So if you look at what's happening in Germany and France in terms of bankruptcies, whether you look at the cost of bankruptcies, which is the average liabilities of failed corporates, so if you look at the number of bankruptcies, you see exactly the same trends, which is improvement, clearly, but we are not at the level, not in terms of cost, not in terms of number, or where we were before the crisis. So On the German corporate side, you see that, of course, the crisis has been less severe than in France, and that's come later. And it's explained by the fact that the average corporate in Germany is stronger, financially speaking. But still, you've had a shock. You've had bankruptcies in Germany very large because you've had a very huge recession, huge to trade crunch. And some corporates have been fragile. And by the way, you know that one of the largest corporates for credit insurer has been taken place in Germany, which is Arkandor. But we have excluded Arkandor from the numbers, and still by excluding those numbers, you see that there are some bankruptcies. Things are getting better, faster in Germany because the recovery is faster. But there's also some decent recovery in France, although clearly less dynamic. And you see things are getting better, but there we are not yet there. And one of the issues is that in those numbers, you have a lot of SMEs, and a lot of SMEs who suffer today of the lack of credit. Globally, you do have a positive credit positive credit supply in those two countries, and especially in France, where credit is going well. But you have a large discrepancy between the good, strong, large corporates and the SMEs, which are clearly struggling to get credit. And this is one of the big issues, by the way, with the eurozone crisis. And the same in the US. I mean, we exactly have the same. So generally speaking, we have a lot more bankruptcies and a lot of more difficulties in the US because of the legal system in the US. So when something goes wrong in the US, we have a lot of non-payments very, very quickly. But normally, in the normal situation, we also see things getting better very quickly in the US. So it worsens very quickly, but it gets better very quickly. And we don't see that happening these days. I mean, we see things, of course, are getting better, but we are not in the number of bankruptcies. We don't have the numbers in terms of cost of bankruptcies. And you see that things are not getting better. And I completely agree with what was said. One of the issues for the US now is that the model is changing. So what we are going to have is the US growing much less than before because the consumption bonanza linked to the debt is over, is trying to be over. And then we will have an economy that's going to grow like Europe in a way. So there is a normalization, and so far the US will be able to deal with that. So that's an issue for us, but at least in terms of short term, things are getting better, but still some elements of worries in terms of difficulties. Now, about the Eurozone, much has been said today. Here you see the scariest chart ever, which is the external debt to GDP. So it's not only public debt, it's corporate, plus banks, plus government debt, external, meaning towards non-residents. And what you see in this chart is that, look at the orange, which is Argentina in 2001, Russia in 1998. Why did I choose those numbers at those dates? It's because it was the financial collapse and the default, the sovereign default of these two countries at this date. And you see that the level of debt we are dealing now in Europe is much, much larger than what we had during emerging market crisis or emerging market defaults. So clearly now we are dealing with a level of debt which is extremely high. And I want to make sure on one point is that I've heard this morning that it is a sovereign issue. It's not only a sovereign issue. It has become a sovereign issue for many countries, but look at Spain or look at Ireland. Before the crisis, the public debt was very low. And what has happened is that there has been a private debt bubble getting to the bank, then bailouts to the banks that have become a sovereign problem. But at the start of the problem, not all European countries are Greece, meaning that not all European countries have a real big structural problem with dealing with their public finance and getting fiscal revenues. In Spain or in Ireland, you didn't have fiscal problems before the crisis and before the banking problem. So this is very important to say that some part of the elements, and by the way, there is a lot of thinking now in Europe about not only at watching public debt, but also at watching private debt bubble, which are extremely dangerous for the economies. So anyway, you do have these issues. And so today it was very gloomy. So is the Eurozone going to collapse? No. I mean, people will stay in the Euro. And I think I'm not thinking that no one has interest with this level of debt to get out of the Eurozone. Because you have to understand that it's a very high external debt, but it's a European debt. European banks and Eurozone banks own the debt of other Eurozone countries. So in a way, it's a tragedy because we are stuck together. Because if someone gets out, he will not be able to pay its debt, and all the system will collapse. So we have to bond together, and this is why no one wants anyone to get out of the euro. You might say, okay, so Greece, if Greece goes out of the euro, there will be a massive default, not only of the government, but of banks and of corporates. We'll have a huge issue on European, French, German banks. So that's the first problem. So no one wants the Greece out of the Eurozone. Was Germany has an interest to go out of the Eurozone? Certainly not. It's an export-led economy with, like China, benefits of, let's say, quite a decent exchange rate, despite the appreciation. If Germany goes out of the eurozone, they will have their Deutschmark going up very much because it's supposed to be the zero-risk country, and then they will have a problem with their exports. So I don't think no one has interest so far to go up the eurozone. I say so far. So I think it will stuck together. My issue is that the problem, because we are dealing with corporates, and again I stress that this eurozone crisis clearly weighs on European corporates. So there are many channels from the government to the corporates. Of course, there is recession. Of course, there is austerity package. There's a lot of stimulus that withdraw, and so the corporates are less supported. But the main channel is credit. And one of the problems is that you have seen the boom of credit in those banks, you know, and especially if you look at Ireland, it has been completely crazy. The credit boom from Irish bank to Irish corporates. And of course, now you see the huge credit crunch, because the problem is that those banks, loaded with sovereign exposure, they don't have the ability to sustain growing credit or credit supply. And what you see now happening in Ireland is that a lot of corporates fail because of the lack of access to liquidity. So clearly one of the big issues is we have a sovereign issue in a sovereign problem or sovereign debt restructuring is how the bank will deal in terms of the credit market. And now the credit is slowly recovering in Europe. If there is a problem, it will be cut. And then we have an issue of corporates. So this is why we are very, very scary. I mean, we are scared about what's happening in those countries for the corporates because they have a lack of access to credit. So what about emerging markets? I think it has been said a lot. Of course, we are in another world here, in a world of low debt, low public debt, low external debt. So that's of course a very different, way the world has evolved clearly, because we never thought that country risk would be so high in eurozone and so low now in terms of countries and emerging countries.